Hello, and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at MoneyShow, and today I'm speaking with Jim Bianco, President and Macro Strategist at Bianco Research. Welcome to the podcast, Jim.
Oh, thanks for having me.
All right, let's start big picture. I mean, you're a macro strategist. Where do you stand on sort of where we're at in the market and economic cycle here? Optimistic, pessimistic, somewhere in between? Just kind of curious as to your big picture take.
A unique optimist. Big picture. Biggest event of our lifetime, unless you're 100 years old, was the shutdown restart of the economy. We rebooted it, and I'm talking about the global economy. We sent everybody home, and then we tried to bring them all back to work, and it never came back the same way. It's different. Now, don't confuse different with dystopian. It's not worse. It's different. Work from home is the thing that we all know the most of, that we're not all going back to the office 5 days a week, and there's a transformational change in the way that people work and the way that we view work. Look at all the labor strikes and everything that we've not seen for decades that are now starting to pop up, that employees have more power over employers. Because we're home more, pre-pandemic, I was home 2 days a week, Saturday and Sunday, like everybody else. Now you might be home 3 or 4 days a week. Your lifestyle's changed. And because your lifestyle's changed, now your consumption basket's changed. So things like retailers to inventories to supply chains have all got to reorient themselves to this new economy. Now, none of this is bad. It's just different. The problem comes in when you get a lot of people that are saying, no, nothing has changed. You just wait. Everybody's going to go back to the office 5 days a week, as Dave Solomon of Goldman Sachs likes to say. Or, it's all going to return to normal, or it's all going to rebalance, which Jay Powell said the week before we're talking 5 times during his Q&A at the New York Economics Club, a belief that nothing really changed. And I think that that's really what's causing the inflation that we're seeing, the volatility that we're seeing in markets. We're out of balance. We just got to get everything back into balance. And kind of like a 12-step program, 2/3 of the way of getting everything back into balance is admitting we have to do that instead of using words like normalization and rebalance and getting back to where we were and everything that we kind of say, because what that suggests is nothing has changed. So my outlook is we're going to stay in this higher inflationary environment. We're going to stay in this more volatile environment. And we've turned the cycle on interest rates. We're going to stay in a much higher interest rate cycle, which means more competition for traditional investments like equities.
It's interesting. When we go back to sort of the pre-COVID era, you mentioned on Charles Payne's show the other day that the sugar high the Fed had fueled in bonds. We had this 10-year run where they were in there buying, bond yields stayed low and so on. And a lot of market participants aren't appreciating the big paradigm shift we've had. Can you talk a little bit about that?
Sure. One of the patterns we've seen all year is even going back or further, a year ago, when Bloomberg famously, almost a year ago to the day we're talking, famously predicted a 100% chance that there would be a recession in the next year. There hasn't been anything near that. And 100% implies certainty that there would be one. They said it's because higher interest rates are going to punish the economy. Every quarter we've seen the GDP forecast start off at below zero. This quarter is going to be a contraction. It's going to be the start of recession. By the end of the quarter, they've got very strong growth. And we're continuing to say that. The week we're recording, we're going to get the third quarter GDP, and it's going to be a blowout, huge number. But don't get too comfortable, because the next quarter or the quarter after that is going to be a contraction. We've heard this now 4 quarters in a row, I think. And really what it's boiled down to is this belief that interest rates are punishingly high. Why do they think that? Because they compare them to the 2009 to 2020 period. That was the QE period.
Yep.
That, I've argued, was the sugar high period. Let me restate it. That was the abnormal period. What we're seeing now is a return to normal. And yet we think this is abnormal, and that 2009 to 2020 period was normal. We've got our anchoring all backwards right now. If you look before 2009, what you're seeing with interest rates is they're returning to the levels that we used to see before the QE period, before the great financial crisis period. And the economy could handle those kind of rates just fine. I think that's what we're seeing now with the economy. These are not punishingly high rates. It can handle them. The big difference is the stock market. Long term, Dr. Jeremy Siegel just updated his seminal book, Stocks for the Long Run. And in it, he says, if you own stocks for a very long period of time through all the cycles, you should expect, and I'm just summarizing this, 8%. 8%. Yeah, you'll have better than 8 in some years, worse than 8 in others, and you'll average 8. Well, now all of a sudden, money market funds are yielding 5.5. I could get well over half of the return of the stock market without any market risk. That's the big difference with this cycle now. There is an alternative, where in 2009, it was TINA. There is no alternative. And that's going to reshape the landscape of investing, even though these higher rates might not be punishing for the economy.
Let's talk about the stock market there a little bit. You mentioned on Twitter recently that we've just had kind of the deepest pullback, about 8% on the S&P since October of 2022, and we did cut through the 200-day moving average to the downside. So from a technical and sort of a standpoint for the fourth quarter, what are you looking for here? What do you think the significance is of those kinds of developments?
Yeah, what I also highlighted in that tweet thread too was that if you take the Magnificent Seven stocks out, now we actually went all the way to the Russell 3000. And if you take them out, the other 2,993 companies collectively as a group are down on the year, at least they were through Friday, October 20th. And really what it shows is that the stock market, after bottoming last year with a 25% correction and people saying that was the bottom of the bear market, it is really struggling to get any kind of upside momentum. There is upside momentum in 7 stocks. There really isn't upside momentum in 2,993 stocks. And to me, this looks like it may not be the start of a bull market. Now, I'm defining a bull market as meaning the uptrend that will soon take out the all-time high. The all-time high is still, meaningfully above us, and it's now been almost 2 years since we've been there. Now, that doesn't mean that we're in a period where the market's going to get killed or it's going to go down. We're in a period where it's going to kind of meander sideways. And so what I've been telling people is I think that the era of just buy broad-based index funds for equities might be behind us. If we're going back to a 90s or 80s style level of interest rates that the economy can handle, then maybe we ought to start thinking about investing in the 90s or 80s the way we used to too. And that is the old Peter Lynch picking stocks. Now, what stocks am I going to need to pick? Let me go back to my earlier comment. Transformational change in the economy, the reboot of the economy. We need to restructure the economy to get rid of the imbalances. We need to change supply chains. We need to rethink how retailing works. We need to rethink what our consumption basket is and our lifestyle now that we're home more. Those are the types of investing ideas I think that we should be looking towards in the next coming years, and not up or down S&P 500, up or down QQQ. That worked great for 20 years, and that especially worked great in the post-2009 period. But I'm not so sure that that's the investing style that people should be looking at going forward.
Does that point towards any specific sectors? I don't know how comfortable you want to be talking about individual names, but I'm curious to sectors or groupings. What sort of falls into those baskets as promising then?
Yeah, I like everybody else. I've laid out as a macro strategist the way that I'm viewing the world. I'm still trying to figure out where we should be going. And what I'm really trying to say is when Jay Powell and everybody else says normalizing, rebalancing, we're going back to 2019. No, that's over. That area is over. Now I'm trying to figure out what the new era is. And again, new, different is not worse. It's, your boss may not like it that everybody's staying at home, but the employees like it, like everybody's staying at home. So is work from home worse? No, it's not. It depends on which angle you look at. But within that, I still think that shipping, I still think that in manufacturing, I still think that logistics or transportation, these old line industries need some disruption. And I would be looking at the disruptive forces that may come into these areas to give them the sorely needed changes. Just like I also think another old line industry that needs to be disrupted is the financial and the banking industry, and things like fintech and stuff hold a lot of promise now, especially after fintech, dare I say crypto too, and crypto as well, got crushed in the last couple of years, that there's some real values because ultimately I think some of the changes are there. So I want to start thinking about the economy in those terms, and not necessarily saying that the answer to all of these ills is going to be AI or it's going to be something that is in the super high tech area. There is going to be a lot of solutions that are going to come out of that area, but some of these other solutions will be more, let's say, current tech. I don't want to say low tech, but just say current tech. It doesn't have to be super high tech, artificial intelligence or chat GPT type of levels.
Okay. Let's talk briefly in the time we have left about other assets then. I mean, obviously, after a year for bonds that we had in 2022, there was a lot more optimism this would be better. And clearly, I think you mentioned it's sort of the second worst year we're on track for. I mean, after we reprice this higher for longer kind of market, is there going to be opportunity in bonds out there, precious metals? I'm just kind of curious as your take in some of those other sectors.
Yeah, you're right. Sticking with bonds, the worst total return year recorded, and I mean, as in data back to 1790, was 2022. 2023 was supposed to be, because Wall Street's got this powerful drug called mean reversion. Show them something that's down a lot, oh, you got to buy it. Show them something's up a lot, oh, you got to sell it, because they always think there's going to be mean reversion. And there is, but you just don't know what mean you're reverting to. So when everybody looked at 2022 being a disaster, they said, well, 2023 is going to get better. But in reality, it's, making a run being the second worst year ever. Now, I think that sets up a great opportunity in the bond market, because there's a yield again in the bond market. You are going to be buying bonds with a 5% yield. If you go into high quality corporate bonds, a 6% yield. You are going to get paid if nothing happens in the bond market. You're going to get now approaching, especially in high quality corporate bonds, 2/3 of the returns that you can get in stocks without nearly the risk in stocks. Now, the good news is the bond market is going to start providing us opportunities going forward. The bad news is we had to suffer through unbelievable and unspeakable horrors in terms of total returns to our investments to get to this place. But I think we're finally starting to get to this place. Now, I'm not suggesting that I'm necessarily outright bullish on bonds. I still think yields are going to go up, which means prices fall. But the cushion you're going to get on your yield, on your investment in bonds, that income that you're going to get, should, starting very soon, if not right now, more than make up the declines that you're getting. The declines right now that we're seeing in the market is part of a readjustment process. The day we're recording, the 10-year Treasury went over 5% for the first time in 17 years. And it seems like it's in a free fall. Yeah, it is right now. But I'm trying to think about 2024 and into 2025 as opposed to this period right now. Other asset classes, precious metals, there seems to be a bid that is as we're talking about things like gold, but that might just be a safety bid given the uncertainty in the rest of the world. I still don't think that the dollar, the way that the dollar, I look at the dollar and I look at that kind of investments in foreign investments. I like to paraphrase Winston Churchill, that the dollar as a reserve currency is one of the worst reserve currencies ever made, except for all the other options. So yes, you can tell me all of the terrible options and all the things that are wrong with the dollar. And not only will I agree with you, I'll say you left off the list a whole bunch of others. Okay, but every other alternative is far worse. Yeah. So I'm bullish on the dollar by default, is where I'm at. So what does that mean? I always want to invest with the currency that's the strongest. And if that's going to remain the dollar, I think domestically, I want to stay more with the US than I want to be outside of this country.
Okay. We're about a month and a half out from the Sarasota Investment Masters Symposium that you're going to be speaking at. A lot can change, obviously, in that period of time in markets and the economy. But I'm wondering, is there any sneak peek you'd be able to give to anybody watching this or listening as to what you think you might be talking about?
I'm going to be talking about change. In fact, a lot can change in the month and a half. A lot can change by this afternoon, by the way that these markets are going right now. And I want to talk about the change in the economy. And I want to talk about how there was a major cycle shift with that shutdown restart. By the way, it didn't create a new cycle. It took cycles that were already in place of deglobalization, work from home, and those types of things, and sped them up. A friend of mine said it's like we're in one of these sci-fi movies where we went forward in time 20 years or 25 years. Where we are in the cycle, we were going to get here. in a quarter century. We just got here in 3 years. Now we need to kind of figure out what this cycle is and start to adapt to it instead of looking backwards, yelling normalization, rebalancing, get back to work, you lazy bum, get out of your pajamas. Those eras, we're not going back there. So that's what I want to, pretty much try and lay out during the Money Show in December. And I'm quite excited to do it as well.
Okay. Excellent, Jim. Well, really, thank you so much for your insights, and thank you everyone who's watching. If you do want to hear more from Jim and dozens of other trading, investing, and economic experts, I do encourage you to check out the Investment Master Symposium here in sunny Sarasota, Florida, scheduled for December 4th to 6th at the Hyatt Regency, and you can find out more information in the link below. Jim, thank you again for your time. Really appreciate it. Looking forward to seeing you in December.
Looking forward to it as well.